There's a threshold point in every economic system where the basic math of daily life stops working, where the income required to maintain normalcy exceeds what the majority of people can actually earn. America crossed that threshold sometime in late 2023, and what we're watching now is the slow motion adjustment to that new reality. You can see it in utility disconnection rates that have tripled in major metros, in credit card charge-offs hitting levels unseen since 2009, in the fact that home inspectors, people who made steady money for decades, are going weeks without a single job. These aren't isolated data points. They're symptoms of a system that's recalibrating, violently, to a new equilibrium. And the most unsettling part? Most people still think this is temporary.
The mechanics of this shift are hiding in plain sight. Start with labor force participation, the percentage of working-age Americans who are actually employed or looking for work. It peaked decades ago and never recovered. Even during supposed economic booms, millions simply stopped participating in the formal economy. That's not a labor shortage. That's a market signal that the jobs available don't justify the effort required to get and keep them. Now layer in housing costs. The ratio of median home price to median income used to hover around 3-to-1, meaning 3 years of income would buy a house. That ratio is now pushing 7-to-1 in many markets, higher in major cities. But it's not just home ownership. Rents followed the same trajectory. A typical one-bedroom apartment in a mid-tier city now costs what a mortgage payment did 20 years ago. This creates a spatial sorting mechanism that's invisible until you map it. Workers earning service sector wages cannot afford to live in the areas where service sector jobs exist. They either commute from progressively farther distances, costing them hours and money, or they exit the market entirely. The businesses needing those workers either raise wages to unviable levels, reduce service offerings, or close. The problem compounds when you add transportation. American metros sprawled outward for decades, building suburbs with no viable public transit. Workers can't afford to live near their jobs, so they commute. That commute requires a car, insurance, gas, maintenance. The Transportation Department estimates the average household spends over $10,000 annually just getting around. That's not discretionary spending. It's a mandatory cost of participating in the economy. And here's the mechanism that makes this unsustainable. Transportation costs are regressive. They consume a far larger share of income for low-wage workers than high-wage workers. A service worker earning $30,000 who spends $10,000 on transportation is losing a third of their income just to get to work. That math doesn't work. Eventually, they stop working, or they move somewhere the equation makes sense. Healthcare operates as another mandatory deduction. Even with insurance, the average family pays thousands in premiums, then thousands more in deductibles before coverage actually kicks in. Routine prescriptions, basic checkups, emergency visits, all extract wealth from households that are already stretched thin. The healthcare cost structure has become particularly warped. Insurance premiums rise annually, but coverage shrinks. Deductibles increase. Copays increase. The share of healthcare costs that insurance actually covers has declined steadily for 2 decades. Families are paying more to be insured while receiving less actual coverage when they need care. That's not a functional insurance model. It's a wealth transfer mechanism. Add utilities. Energy costs spiked during the inflation surge and never fully retreated. Grid modernization, extreme weather, deferred infrastructure maintenance, all translate into higher bills. Water and sewer systems face similar pressures. Municipalities deferred repairs for years, and now they're passing modernization costs to ratepayers who can't afford them. The utility situation reveals the infrastructure crisis beneath the surface. American water systems, electrical grids, and sewage treatment facilities were built in the mid-20th century. They're aging out. Replacement costs are astronomical. Local governments don't have the capital, so they raise rates on existing users, which pushes more households into arrears, which reduces revenue, which makes the infrastructure problem worse. The math here isn't complicated. Take median household income, subtract housing, transportation, healthcare, utilities, and food. What remains is significantly less than what's required for anything beyond bare survival. No savings buffer, no retirement contributions, no emergency fund, just the constant calculation of which expense can be delayed this month. This is the hidden subsidy that kept the American lifestyle afloat for decades. Workers accepting compensation that didn't actually cover their cost of living. They made it work through household debt, dual incomes, extended work hours, and geographic arbitrage. But each of those coping mechanisms has limits. Debt eventually maxes out. Dual incomes don't help when both earners face the same income-to-cost gap. Work hours only extend so far. And geographic arbitrage stops working when cheaper areas become expensive too. This is where the behavioral shift becomes visible, and why the conventional economic indicators are missing what's actually happening. When households can't cover basics with current income, three behaviors emerge. They cut spending, they take on debt, or they stop participating in parts of the economy entirely. All three are happening simultaneously right now, and each one reveals something about where this leads. The spending cuts show up first in discretionary services. Home repairs get deferred. Maintenance gets skipped. People start doing their own work rather than hiring professionals. This is why handymen report empty calendars and home inspectors go weeks without calls. The demand exists. Houses still need maintenance, but households are choosing to live with disrepair rather than pay for labor. That behavioral shift cascades through local economies. The handyman who loses half his clients cuts his own spending. The restaurants he used to frequent see less traffic. The mechanics, retailers, and service providers who relied on his income see their revenue drop. Local economic activity contracts because households at every income level are simultaneously pulling back. This creates a measurement problem for conventional economics. GDP might remain stable because online retail compensates for local retail declines. But the nature of economic activity changes. Money that used to circulate through local businesses now flows to distant corporations. The multiplier effect that kept local economies healthy disappears. A dollar spent at a neighborhood restaurant generates several dollars of secondary economic activity. A dollar spent on DoorDash generates far less. Debt fills part of the gap. Credit card balances surged past $1.2 trillion. Auto loans climbed even as car ownership became more expensive. Student loan repayments resumed after years of pause, and delinquency rates immediately spiked above 9%. This isn't people borrowing to upgrade their lifestyle. This is people borrowing to maintain it. The critical threshold arrives when debt service costs exceed what households can sustainably pay. Credit card interest rates now average over 20%. A household carrying $10,000 in balance pays $2,000 annually just in interest. That's $2,000 not going toward rent, groceries, or any other essential. It's wealth extraction that makes the underlying problem worse. Watch what happens in the charge-off data. Banks write off debts they've determined are uncollectible. Those write-offs hit levels unseen since the financial crisis. Each charged-off account represents a household that borrowed to stay afloat and couldn't repay. The system worked until it didn't. And now the losses are mounting across multiple debt categories at once. And here's where the system dynamic becomes dangerous. When enough households hit this threshold simultaneously, the financial institutions holding that debt start seeing losses. Banks write off charged-off accounts. Credit tightens. Lending standards increase. The households that were barely managing with access to credit suddenly lose that access, and their situation deteriorates rapidly. We've seen this pattern before. Not the exact same mechanism, but the same structural dynamic. When too many households become financially fragile at once, small shocks create cascading failures. A modest uptick in unemployment, a regional economic slowdown, even just the exhaustion of available credit, any of these can tip a large population from struggling to crisis. The employment situation adds another layer. Headline unemployment remains low, which suggests labor markets are healthy, but the composition of employment has shifted. Full-time jobs with benefits declined as a share of total employment. Part-time work, gig work, contract positions, all increased. These arrangements offer flexibility for employers and insecurity for workers. Income volatility is the real killer. When paychecks vary week to week, budgeting becomes impossible. A household might make decent money one month and fall short the next. That variability makes it hard to commit to fixed costs like rent or car payments. It means any unexpected expense, medical, automotive, family emergency can trigger a financial spiral. The gig economy was supposed to offer freedom and flexibility. What it actually delivers for most participants is unpredictable income and no safety net. No paid time off, no health insurance, no unemployment insurance, no workers' compensation. Just the raw exposure to market fluctuations and personal circumstances with no institutional buffer. That exposure matters when economic conditions tighten. A traditional employee who gets laid off can file for unemployment benefits. A gig worker whose income drops has no such recourse. They just earn less and have to figure it out. That asymmetry makes the labor market look healthier than it actually is because the stress doesn't show up in unemployment statistics. This connects to the infrastructure decay happening in service availability. Businesses facing higher labor costs and uncertain demand respond by reducing hours and cutting staff. The coffee shop that used to open at 6 now opens at 8. The pharmacy closes an hour earlier. The grocery store reduces overnight stocking shifts. Each individual business makes a rational decision based on their economics. But when every business makes the same decision simultaneously, the collective result is a degradation of service infrastructure that makes daily life harder for everyone. The feedback loop intensifies. Reduced service hours mean customers adjust their behavior, shopping less frequently or shifting to online alternatives. Lower foot traffic justifies further hour reductions. Staff gets cut more. Service quality drops. The local economy contracts further. This isn't just inconvenience. It's the market signaling that the previous level of service provision was economically unsustainable at current wage-to-cost ratios. The economy is contracting toward what it can actually support given the underlying constraints. Geographic disparities amplify these dynamics. Rural areas and small towns face the sharpest declines because they lack the population density to support even basic services at current cost structures. The grocery store closes because it can't maintain profitability with reduced customer traffic. The nearest alternative is now 30 miles away. That distance barrier makes the area less livable, which drives more people to leave, which reduces customer base further. Urban cores and wealthy suburbs maintain better service availability because they have concentrated demand and customers who can afford higher prices. But even these areas see degradation. The independent businesses that gave neighborhoods character close, replaced by chains that can absorb higher rents and labor costs. The diversity and local flavor that made urban living appealing homogenizes into a standardized corporate landscape. And the spatial implications are already reshaping where Americans can afford to live. The underlying dynamic here is simpler than it appears. For decades, the American economy operated on an implicit subsidy. Workers who accepted wages below the actual cost of living in their area. This worked only because of specific conditions that no longer exist. Housing used to absorb a predictable share of income, roughly a quarter to a third. That left enough for everything else. When housing costs doubled or tripled as a share of income, the entire equation broke. Workers either needed much higher wages, or they needed to leave the market. Many chose to leave. The same pattern played out in commercial real estate. Small businesses locked in long-term leases at rates that made sense when they signed. But property values surged, and when those leases renewed, the rent increases were catastrophic. A restaurant that paid $4,000 monthly suddenly faced $8,000. The business couldn't pass that cost to customers without losing them. So they closed, or moved, or operated at reduced capacity. This created a spatial sorting mechanism. Only high-value businesses can afford high-rent locations. Everything else either consolidates or disappears. That's why retail districts start looking the same. Chains with national backing can absorb the costs that local operators cannot. Walk through any American downtown, and you'll see this pattern. The local bookstore closed years ago. The independent coffee shop became a Starbucks. The family restaurant is now a chain. The hardware store is gone. What remains are businesses with sufficient scale to absorb higher operating costs and negotiate better lease terms. The diversity that made communities distinctive evaporates, replaced by standardized corporate offerings. The labor market reflects this same sorting. Jobs that can't pay enough to cover local living costs either disappear or go unfilled. The work still needs doing, but the economic model can't support paying someone enough to live nearby and do it. So either the work doesn't get done, or it gets done by people commuting from cheaper areas, or it gets automated away entirely. Automation is often framed as technological progress, but in this context, it's a response to economic constraints. Self-checkout exists because labor became too expensive relative to transaction value. The kiosk doesn't need housing, transportation, or healthcare. It's a one-time capital cost instead of an ongoing labor expense. From a business perspective, it makes perfect sense. From a societal perspective, it eliminates entry-level work and consolidates wealth. The automation dynamic reveals something critical about how this adjustment unfolds. Technology doesn't replace human labor equally across all tasks. It replaces the most routine, predictable, low-skill work first. Those jobs were historically the entry points into the labor market. The positions where young workers gained experience, built skills, and moved up. When those positions disappear, the pathway to upward mobility breaks. What happens to the workers displaced by automation? The conventional answer is they retrain for higher skill jobs. But that assumes higher skill jobs exist in sufficient quantity, which they don't. And it assumes workers have the time, resources, and capacity to retrain while meeting their current obligations, which most don't. The actual result is people leaving the formal labor market or cycling through unstable gig work. The geographic implications of this are just beginning to emerge. Regions where cost of living remains manageable will see population inflows. Regions where costs exceed what local wages can support will see outflows. This isn't about preference. It's about survival math. If you can't afford to live somewhere on the available wages, you leave. That outmigration hollows out communities and reduces the tax base that funds local services, which accelerates the decline. We're watching this play out in real time. Major metros that saw decades of growth are now experiencing net population loss. The people leaving aren't failing. They're making rational economic decisions. They're moving to places where the income-to-cost ratio still works. But as more people make that same calculation, even the cheaper regions start experiencing cost pressures. This creates a cascading effect across the national housing market. When remote workers from expensive cities move to cheaper areas, they bring higher incomes and push up local prices. The existing residents who work local jobs suddenly can't afford their own neighborhoods. So they move to even cheaper areas, repeating the cycle. Each wave of migration pushes the affordability crisis further into what used to be affordable regions. The political implications are significant, but underappreciated. When large populations become economically precarious, they become more politically volatile. Stable middle-class populations tend toward moderate politics and gradual reform. Populations facing financial insecurity tend toward more extreme positions, either demanding aggressive intervention or blaming external forces for their decline. The macro indicator that will eventually reveal this is consumer spending. The economy depends on consumption. When households are financially constrained, spending falls, not discretionary spending that already declined, essential spending. When people start cutting back on basics because they genuinely cannot afford them, aggregate demand contracts. Businesses see less revenue. They cut costs further. The cycle reinforces. This is different from a typical recession. Recessions are usually triggered by specific shocks, financial crisis, trade disruption, policy mistake. This is a slow-rolling adjustment to structural imbalances that accumulated over decades. There's no single moment where it tips, just a gradual tightening until something breaks. The financial system carries its own risk in this environment. Banks profit from lending, but only when borrowers can repay. As delinquency rates climb across multiple debt categories simultaneously, financial institutions face losses. Not enough to trigger immediate crisis, but enough to make them more cautious. Credit standards tighten. Marginal borrowers lose access. That accelerates the contraction. Meanwhile, asset prices reflect a different reality. Stocks trade at elevated valuations, based on corporate profits that depend on consumer spending. Real estate prices remain high, based on the assumption that demand will persist. Both assumptions become questionable when household finances deteriorate. The correction might be orderly, or it might not, but the gap between asset prices and economic fundamentals keeps widening. The wealth effect operates in reverse too. When households feel wealthier because asset prices rise, they spend more. When they feel poorer because their financial situation deteriorates, they spend less. Consumer confidence surveys show this psychological shift already underway. People report feeling worse about their finances even when headline economic numbers appear positive. What makes this particularly difficult to address is that the mechanisms are distributed. There's no single lever to pull. Raising wages helps some workers but increases costs for businesses. Building more housing helps with supply but takes years and doesn't address existing debt loads. Reducing interest rates might stimulate borrowing, but doesn't fix the underlying income-to-cost mismatch. The policy response so far has been to treat this as a cyclical problem rather than a structural one. Stimulus during downturns, rate adjustments during inflation, modest interventions at the margin. But these tools address short-term fluctuations, not long-term imbalances. The underlying ratios, housing costs to income, transportation costs to wages, healthcare costs to earnings, keep moving in the wrong direction regardless of policy interventions. The most likely path is a grinding adjustment where living standards decline gradually, not catastrophically, but persistently. Households adapt by lowering expectations, cutting costs, and accepting less. Businesses adapt by operating with less staff, fewer hours, and lower service levels. Communities adapt by maintaining less infrastructure and providing fewer services. That's the equilibrium we're moving toward, a version of American life that functions at a lower level of resource intensity and consumption. Not because of choice or planning, but because the economic fundamentals no longer support the previous level. The collapse of everyday life in America isn't a crisis in the traditional sense. It's an adjustment. The previous equilibrium, where service sector wages could support local living costs, depended on conditions that no longer exist. Housing costs exceeded wage growth. Transportation became mandatory, but expensive. Healthcare consumed larger income shares. The math stopped working. What we're experiencing now is the market correcting toward a sustainable balance. That balance involves less service availability, reduced operating hours, more self-service, and lower expectations for convenience. It means households cutting back, taking on debt, or leaving markets where costs exceed incomes. It means businesses operating with skeleton crews or closing entirely. This isn't temporary. The forces driving this adjustment, housing costs, wage to productivity gaps, infrastructure decay, are structural. They won't reverse without intervention on a scale that seems politically unlikely. So, the more probable path is continued grinding adjustment until a new normal emerges. That new normal looks like an America where everyday life requires more money, more time, and more personal resourcefulness, where the middle class experience involves tolerating service degradation that would have been unacceptable a decade ago, where economic fragility is widespread enough to be unremarkable. You're not imagining the changes you're seeing. The system you grew up with is recalibrating. And the question isn't whether it continues. It's what level it settles at, and whether you're positioned to navigate what comes next. If this breakdown showed you something you weren't seeing before, subscribe. The mechanisms driving this shift are accelerating, and understanding them before they fully materialize is the difference between adapting and getting caught off guard.